Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated, her website jugglingdynamite.com. Welcome back to the show, Danielle, and Happy New Year.
Yes, you too, and to the listeners.
Danielle, are we experiencing one of the biggest financial bubbles of all time? And what's the fallout of that going to be?
Well, there's no question that we are. Octogenarians, the few that we have left that have memories long enough to have actually lived through, the last 60 or 70 years of market history, are pretty much unanimously agreed on that. Plus, the statistics suggest that that's the case. I've been active and cognizant of market cycles since the 90s, and I remember very well the tech top in 2000, and that was a really, truly historic bubble. But this one rivals it on many fronts. In fact, arguably across more asset classes, this one is much worse. And it's far above the levels we saw in terms of valuations and speculation, even in the 2007 top, just before the great financial crisis. So it is really mind-boggling. It is one that has been born of incredibly weak financial policies and regulation, revolving doors, and the financial sector that's basically just got away with whatever the heck it feels like for the last decade, aided and abetted by, as I say, the revolving door regulators who come and go from major corporations. The latest one, the Robinhood crowd, I've spoken and written about Robinhood as this online app which attracts 30-somethings to the idea of speculating as a game. And in the process, they sell, of course, a lot of margin debt for people to do this on a levered basis, as well as fractional shares, because these are the broke folks who don't actually have any money per se, but they have access to credit and the ability to buy fractional shares, options, which are another form of participation, a highly levered way to participate, where you can win big gains, but you can lose a fortune when it goes the wrong way. So you've got this is just sort of the poster child for this era where we have this kind of highly destructive behavior widespread across most age groups, from the young, as I mentioned, who are attracted to many of these apps, to even the old who are, trying to find alternatives to near zero rates, or, frustrated that they can't produce more income from their savings, and so they've all taken up this idea that you have to gamble to try and win. And, the irony, of course, is that it's the financial sector that's winning again, because they have been able to, they make huge profits when things go in their favor, and then they get bailouts from governments and central banks when they should be losing. And just back to the Robinhood example, that was a startup that's really been taking in new investment dollars over the past year. It was originally began by people who developed high-frequency trading algorithms. So after they figured out how to profit from the flow of retail customer orders by selling the flow to high-frequency trading firms, they then designed the Robinhood app so that it would capitalize on these customers perfectly. And so they've been extremely successful. They've attracted a whole bunch of new customers and accounts, and they've got record, trading going on their platform, and then they've been selling the flow to the high-frequency traders that they originated with. So, of course, that's a perfectly symbiotic relationship for them. And then they are now courting Wall Street to go public. in order to sell their company to the public. In fact, sell the public to itself, because that's the customers that they're profiting from now and aggregating to, make their value proposition to investors, which then they will turn around and Wall Street makes a fortune underwriting the shares, and the unsuspecting buy the shares, and maybe they go up for a while. But typically these IPOs, initial public offerings that came out in, again, record volume in 2020 relative to the last top we saw in 1999, typically IPOs will fall in value in the months and often years thereafter, because they are so heavily hyped in price and marketed to the unsuspecting public as insiders cash out. IPOs are the way that insiders make their fortune solidified, by taking risk off the table, taking cash out and handing it to the investor crowd, who are really, oblivious to the risk that they're taking, and hoping that they too can win a way to somehow retire someday. So really we've just got all these fragments going on in this, really, whether it's, small cap stocks like the Russell 2000, or whether it's, the S&P 500, whether it's Bitcoin going to 40,000, whether it's, pretty much anything. Like the tech sector, obviously, the semiconductor index has gone straight up in the since March. Everything has really gone into a parabolic formation. So all we know is that these parabolic formations, these straight lines up, this euphoric behavior, this buying companies well over 10 times sales, so that, just as a thought, if you're buying shares of a company that's trading at more than 10 times sales, it means that they would have to give you every single dime that they bring in revenue for the next decade, without paying any expenses, would have to flow to the shareholders to give them back their money over that time frame. And of course, companies have expenses and all sorts of payouts to executives and other things that mean they can't possibly flow every dollar back to shareholders. So it's just a Looney Tunes time. And although I consider myself a very experienced person at this point, I've been at this, and I'm in my third decade as an asset manager. It's still surprising in some ways, because my memory remembers well the last two bubbles and the bursts and the catastrophe that befell so many people thereafter. And you'd think that more people, certainly of my generation, would remember it better, but most seem to be with the blinders on. It's hear nothing, see nothing, do no math, and so they're really just set up for another major drubbing. And it's interesting because it started to happen in March, right? We saw this reconnection between the real economy, the revelation of how extreme the pandemic was and how brutal it was going to be on the economy and so many businesses and households. And so you saw the stock market finally capitulating to that reality, the fact that earnings forecasts, for example, for large cap companies are not expected to be higher in 2022 than they were in 2019, and yet stocks have rallied about 40% between then, the price level of 2019 and now. So that is just pure volume, it's pure expansion in the multiple, the price paid for a diminishing supply of earnings. Many of these companies are selling with no net earnings at all. They're just selling on revenue, which again makes no sense on an investment thesis. But again, if you're not doing any math and you're thinking of it as a gamification thing and maybe we can win our way to prosperity, I've always said there's broadly three camps of people that use financial markets, and one of them is the broke and the desperate, who basically thinks we have to win because we can't possibly save enough, or we haven't saved enough, or we need to spend so much more than our resources will afford, so we have to literally hope that we can win our way out of this financial disaster they find themselves in. So that's the first group. The second group of people have financial discipline, but they don't appreciate the extent to which markets are devised to take their money from them, and so they go into it with some kind of blind faith that putting money into assets at any price is called investing. And of course, those are the people that have their head handed to them every cycle. and then spend years trying to grow back losses. And then there's a third group of people, of which I and my clients fall, which are people who appreciate, we have personal discipline, we appreciate that markets are designed to take our money, and so we devise a system, which is a rules-based approach, which will not let you risk more than X, or, buy when things are in certain ranges. That will follow whether they're fundamental and technical or whatever your rule set is, controls your risk exposure and sticks with the discipline, because those people are committed to the idea that financial markets can be used to one's benefit, but only if you're very disciplined about your timing and exposure to them. And so Jeremy Grantham is one of the people that I have followed. I came upon, Jeremy Grantham is probably, I'm sure he's 80 by now, but he was one of the founders of GMO out of Boston, which is this famous money management company that's been around. 3 partners started it. He famously called the top of the Japanese bubble when stocks and real estate went into a parabolic point into the late 80s, and he called the top and said, this is ridiculous, this 60 times earnings stuff, and their company pulled out of the equity markets there. And of course, the bubble continued to accelerate for another couple of years after they left, and they were denounced as fools, and they were missing out, and they lost a bunch of assets under management just because people said they wanted to participate, and they were mad that they'd been taken out of these markets. And of course, then the Japanese market fulfilled its destiny, crashed 80%, spent 15 years just trying to claw its way back. And it actually more than 15 years, because it's still nowhere near the peak that it was in the top of 1989. And so Grantham, was vindicated in the end. Their firm ended up attracting a lot more assets than they lost after they were proven to be correct. And again, the same thing happened in the tech top, where they went very bearish on stocks when they were trading at the 45 times earnings and that sort of thing on the U.S. stock market. They pulled back exposure. Again, people were angry because the prices continued to go up into, the NASDAQ went vertical in 1999 and appreciated 100% from 1998 to 1999. And again, Grantham's company lost a whole bunch of assets, and people angry and saying they were fools. And then, of course, the crash happened, and then they were vindicated again. And so anyway, he was just writing recently that he didn't think he would get long enough. He didn't think he'd last long enough or live long enough to see another true incredible financial bubble in such a short period of time, because these things shouldn't happen every decade, because investors' memories typically been longer than a few years, and not super long. People very often make the same mistake every 20 years because a new generation comes in, just like we have the 30-somethings on Robinhood today who had nothing to lose in the last couple of downturns and didn't feel the sting of loss. So they have no concept or reference to what's happening. But in Grantham's terms, he was just saying that this hysteria that we see today is rivaling the South Sea bubble, which happened in the 1700s, or the 29 peak, and certainly the 2000 peak. And that's truly shocking, because again, it's evidenced everywhere. We can talk about why and what factors are driving it and that sort of thing, and there's the fear of missing out for sure. But the reality is that they always end the same way, in a typically an 80% collapse. That's the rule of thumb. That's what happened in the Japanese debacle. That's what happened after 1929. It's what happened in the commodity sector after the 2008 top. So that's typically the kind of decline you get when you get this level of euphoria and madness.
We'll have more with Danielle Park right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine, situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration, with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Value from success, growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Welcome back. We're speaking with Danielle Park. Danielle, there's a record amount of margin debt, people borrowing money to buy these overpriced stocks. How does that usually end?
Well, that's part and parcel, because again, this is the class of people that either don't have very much money and so they borrow more to have greater exposure in the hopes that by magnifying their exposure they will win more in terms of the upside. But of course it's also catastrophic in terms of the downside, because once prices begin to drop, they have margin calls, so they're not able to absorb losses very much before they're forced to sell assets. And when you have a widely margined group of participants, so you've got institutional, you've got hedge funds, you've got the retail sector, everybody levered to the zenith, and very little actual liquidity left. I mean, people talk about cash on the sidelines, but that's assuming that every bit of cash out there is, dying to buy stocks, and that's just not the case. A lot of wealthy people, corporations, institutions, they have to keep a certain amount of liquidity at all times, because it's something they can't speculate with. They have to be very careful of maintaining their ability to meet commitments, pay out promises, liabilities, this sort of thing. So there's cash in the system that will never be allocated to equities. There's another amount of cash that will never buy at these prices because they have a discipline around what they're prepared to pay for things. And so they are just never going to come in at these levels. So essentially, once everyone that will buy has bought, there is no way for the market to go any higher. And this is notwithstanding central banks pumping liquidity and trying to force more appetite. If everyone is basically, already fully loaded with what they can possibly service in terms of borrowed money, in terms of the room they have to lever their portfolios further, you just can't get any more buyers. And that's why we always come to a point where, and it's always when the euphoria is the highest, right? When no one can think of any reason why prices should ever go down again. That's a hallmark of the fact they've been going up so long that people have just an alternate reality now. They believe that somehow it's impervious. And I think it's really interesting if we look at, the 1900s as a period, for example, relative to what's happening today, because we have, for example, we had it was the beginning of a secular bear period in 1900, just like it was in 2000, where, prices again get to historic, nonsensical, economically unviable levels, where people have priced in so much optimism. And in 2000, the reason was, of course, about the internet and the explosion of fiber optic cable and the realization that everyone was going online. And that really was a legitimate theme, but it sparked this over-optimism in terms of pricing in how quickly profits would come from that, because it was a huge infrastructure build. It was a heavily capital-intensive rollout, and it wasn't a profitable rollout for many, many years. So that's the first thing, is people overestimate how quickly, profits will come from many of these new technologies. The same thing was happening in the 1920s. In the 1900s, valuations began very high, and what you saw then was a period of 32 years, believe it or not, where the Dow Jones Industrial Average went sideways, and this is the very hallmark of a secular bear. You get a big expansion, then a big collapse, a big expansion, then a big collapse. That typically happens over a period of perhaps 20 years, but in the case of the 20s, you had about 5 episodes where from 1900 to 1920, the stock market expanded by about 100% and then dropped by about half. So, of course, that's a round trip to nowhere. When you go up by 100 and drop by half, you're back to where you started. It did that about 5 times. And then we had the pandemic as well, if you might remember, Jim, the Spanish flu pandemic, which happened in that period as well. And interestingly, so you had World War I from July of 1914 to 1918. During that period, you had three sort of double and halving in the Dow Jones in the stock market during that period. But that, by the very nature, a war is a lot of government spending and a lot of stimulus going into the economy in its support of that initiative, just like there has been, for example, in the last few years with all the QEs and trying to revive everything from the great financial crisis. So you had a lot of government money moving in, and that did bring these sort of big rallies, but always followed by another big correction phase that basically took back all the progress. And then we had the Spanish flu epidemic, which actually ended in 1920. And during the period when the flu was beginning, and it began during the First World War, the stock market again rallied initially, just as it has done from March till now, for example. But it was when the flu ended in 1920 that the stock market then had another major breakdown, losing 54% from 1920 into 1922. And I think we could be set up for a similar thing this time, where there's been, we've been through this very, very challenging period in the economy. We're not through it yet. As you well know, the spread of the virus is continuing to go exponential in most countries, and we have really shocking statistics and a much lower rollout of the vaccine than many people had hoped. So this whole presumption that we would be back to normal by the second half of 21 is looking really rosy in terms of expectations and highly likely to be disappointed. So you've got all this challenging stuff going on, and it's not that there's not good news or prospects for optimism that are legitimate. For example, for the first time in a decade, you've got the Democrats have a majority in the U.S. government, at least for the next couple of years, and they've made a lot of promises on infrastructure spending, for example, on the Green New Deal stuff and that sort of thing. So we could see the best concerted effort we've seen in some time to put more funds towards those initiatives, and that could be positive in the longer run, because funding is definitely part of the solution. We need to remake energy and many sectors that'll improve efficiencies for the future. So all that is positive. The fact that the Trump mayhem is on its way out the door, the markets like more stability and the economy will benefit from more predictable policies and that sort of thing. That's positive. The fact that we have vaccines coming that will probably eventually, if not as quickly as people hope, but eventually end this particular pandemic. That's all positive and reason for feeling hopeful. The problem is, again, back to asset prices. If asset prices have already priced that in times 3, the likelihood is that you get these positive news stories and then you realize that, well, it's good, but it's nowhere near as good as people had priced. And that's when the next correction phase comes. Like, for example, for Canada, I think it's quite possible that we could be heading into a secular expansion in commodity prices again at some point here. We've been grinding lower since the 2008 top, when again pricing went euphoric and everyone thought that only commodity prices could only ever go up. And of course, they responded with an 80% collapse over the next, into the bottom, into the CRB index actually bottomed about 25% of its prior level in March of 20. So it's quite possible that we could be setting up for another extended demand cycle for commodities, which could be positive ultimately for the Canadian economy in the longer run. But the problem again goes back to this whole risk appetite and speculation that's gone on in the world. So every asset class has inflated as free money and people have gone on these gamification episodes. So everything that's inflated is at risk of deflating at the same time. So even though we may be setting up for a secular boom in commodities, which would be about due now, having been through such a long period of sideways and down prices, the fact is that if we get a major sell-off, for example, in the stock market again, in things like Bitcoin, which is, trading at $40,000 or something today, those kind of bubbles, when they burst, are likely to infect all markets because they are so integrated and globally implicated with one another, including the margin and leverage throughout. So I think that it's very likely that even when the good news, even if we get lots of good news going forward here, there could come, like there was in 1920 to 22, this repricing episode. And ultimately, we're just looking for one more test of the March low to see what the bottom actually will be in this secular bear. I don't think we've seen it yet, and we'll know when we get the next sort of burst of this speculative waves, and we see the forced selling that takes place, and then we'll get a better sense of where a durable bottom may be and an investment thesis that makes some sense. But again, at these prices, it's just a total crapshoot.
We'll have more with Danielle Park right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, how will our economy recover if people are not being vaccinated fast enough against the COVID virus?
Well, that really is by all accounts, we have at least two very efficacious vaccines. So it's a question of when, apparently, because by all accounts, these things will help us to combat this disease. So the problem is, again, one of expectations and pricing. So the bullish argument is that, great, we've got these great vaccines, we're going to roll them out really fast, and by, the summer, people will be back to normal because we'll have at least 60% of the population vaccinated. That was sort of the base case scenario that most people have been working with, or the optimistic economists and Wall Street types, Bay Street types, they've been all sort of factoring in, looking through the valley, so to speak. Well, as it turns out, of course, it's quite complex to roll this stuff out and to get this, these two vaccines required 3 to 4 weeks apart for the amount of numbers that we require. And in the meantime, the pace is going, Bank of Montreal did a study this week just saying, look, Canada's already off the mark by a lot, and less than a quarter of the per capita rate that we are seeing even administration of the vaccines in the U.S. and Britain. We're going to have to ramp up our current, administering of the vaccine by about 13 times, if we're going to get anywhere close to the government's goal, which they stated as a 60% inoculation rate by the end of September. So every week that goes by that we are behind that pace significantly means that the ability to reopen the economy without a lot of distancing and mask wearing and all the stuff that's encumbering commerce presently, all that is going to get pushed out further. So by best case scenario, they were hoping for a 60% immunization by the end of September. At this point, it's looking like that's going to be later than that. Sometime perhaps in the fourth quarter is now the hope. But every time this happens, of course, we're putting, the service sector, small businesses, employment, all these things are going to be under continued stress for that much longer. And we do know that when the emergency phase ends, that's when people typically think of governments pulling back emergency support or central banks pulling back emergency support or looking to raise rates. Well, I think, any of those things are going to be absolutely intolerable because the patient, the economy, is going to be so weak. In a way, we've kept it on steroids through the last many years, and although that, gives the semblance of viability at the time, the underpinnings of it, the actual mechanics, the actual health of the thing, have been weakened in the process. And so, that's sort of, we have to get, obviously, through this pandemic. But I'm looking through the other side of it and saying, even if we get there by 2022, which is now looking like best case scenario is hopefully we have mass mass vaccination and herd immunity and that sort of thing by 2022, we're going to have years of carnage here, years trying to grow back the jobs, years trying to repair the balance sheets, years trying to pay off the debt that's been taken on for this crisis period. And none of that is priced into asset prices today. And I think that's where the final risk is that we need to see this one more, probably deep and lasting price correction phase. And that's going to have carnage of its own in this highly levered environment, but it's ultimately going to bring the end of the secular bear that began in 2000 from dubious valuations to an investment climate again, rather than a gambling casino-style climate. And that's when cash is going to be extremely valuable because so few people will have retained it. And that's when people who have an investment discipline will be able to buy things pennies on the present dollar and actually set themselves up for the next 20 years probably of really solid financial performance. But again, it's getting from here to there, and how many people will do that. And as Grantham pointed out in his recent letter, very few managers today have the mettle or will be proven worth the mettle because most of them are just riding the wave. No actual risk management, no actual long-term thinking, just all, fear of missing out and gambling. And when the losses hit, it's going to be revealed that they actually were adding zero value.
Danielle, thank you so much for chatting with us.
Hey, thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite, her website jugglingdynamite.com. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.